Shopify is an interesting e-commerce company that's accelerating revenue growth, expanding profit margins, and increasing cash flow. Understandably, a lot of investors are interested in a business like that and are asking if Shopify stock is a buy at current valuations. I'll answer that question in this video, evaluating the company's recent revenue growth, its operating margin expansion, the cash flow from operations, the returns on investor capital, and then finally looking at the valuation on a forward price to earnings, price to free cash flow basis, and also doing a discounted cash flow valuation model, which I updated today on Shopify stock to come to the conclusion to apply a rating on Shopify stock, whether it's a buy, hold, or sell. So let's get into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So as I mentioned at the top of the video, Shopify has accelerated revenue growth. It's up to 31% now in the most recent quarter. That's up considerably from where it fell in 2022. Of course, that's a result of the economic reopening, right? Shopify absolutely thrived during the pandemic when people were spending more time at home, avoiding shopping in brick and mortar locations. And so they were shopping online more. It was great news for Shopify. But then when the economic reopen got underway, of course, that was a headwind for Shopify, but it still managed to grow revenue. The revenue growth rate fell, but it was still growing revenue. It was above 0%, as you can see here, which means year over year, even during the times when they were comparing with lockdowns to the times when they were comparing with the economic reopening, they still managed revenue growth, which I thought was impressive. Longer term, I'm optimistic that more and more spending will shift online. Brick and mortar businesses are having a hard time competing with online only businesses, and you're seeing brick and mortar businesses close up shop by the hundreds, by the thousands, as they realize that they cannot compete with the online retailers. Very few, the largest companies like Walmart and Costco and Home Depot also find a way to have a dual strategy that's working well. Otherwise, many of the other companies are struggling in this environment, and Shopify is taking market share of the overall retail spending that happens online and that happens overall. So those prospects will likely remain a tailwind for Shopify for 5, 10, 15, probably 20 years as an increasing percentage of shopping shifts online. When I look at Shopify's operating margin, of course, that big up and down swing is very noticeable, and so I'll address that first and foremost. In 2020, like we talked about, Shopify benefited tremendously when people were shopping online a lot more than usual. And so you saw its margin soar up to the sky in 2020. Then, of course, the economic reopening was negative for the business's revenue growth, but it was still growing revenue. So that's not the reason why its operating margin fell. The economic reopening was not the reason why its operating margin fell. The reason its operating margin fell is because Shopify invested billions of dollars in expanding the services it offers its merchants. Prior to that moment, Shopify left shipping and handling to its merchants. It didn't get involved in that. But during that moment, it decided to invest billions of dollars in offering that service to its merchants. So Shopify spent billions of dollars expanding its logistics network. It made an acquisition of a company called Deliverer, and it paid $2 billion for that acquisition, all of which had the impact of lowering the company's margins, and the uptake from merchants wasn't anywhere near what Shopify was hoping for. And so after a short period of, I don't know precisely if it was a year, maybe a little bit longer, a little bit shorter, Shopify decided this isn't working out and they divested away from that and they sold off that business. They sold off their logistics business and they still partner with that company that they sold it to. They still have an ownership stake in their logistic business, but it's managed by another company. And so Shopify accounts for it in a different way. It accounts for it on its balance sheet as an equity investment, which its value changes as the value of that business changes, but it doesn't account for it on its income statement as a part of its operating expenses. And so that's the primary reason for that big fluctuation down for its operating margin in 2022. And then also that sharp reversal here in 2024 after it divested away from that company. And that allowed its margins to return to the levels it achieved in 2020. I hope that explains this huge volatility in the company's margin. Longer term, Shopify has done a great job expanding its margins with revenue growth, and I suspect that will continue for the next decade or more. It's now become, again, a more of an asset-light business model without the logistics involvement, and that could lead to very nice margins over the next decade or more. Cash flow from operations to sales, you see a similar story here, that big up and down. It's the same reason, the same cause, the up and down for the cash flow from operations. But that number, the absolute number at 18%, is better than the operating margin of 12%. And it's a result of some non-cash expenses, but it's not a big difference for Shopify. The returns on invested capital are also recovering, a very nice number of 19% for Shopify. I'm also going to compare this return on invested capital, as I always do, with the company's weighted average cost of capital. What you want to see as an investor is a company generate ROIC that's much higher than the WACC. So on my spreadsheet where I calculate the discounted cash flow valuation, I also calculate the WACC, the weighted average cost of capital, which you notice is 14% for Shopify. That compares well to the company's ROIC of 19%. So its ROIC is greater than the WACC. That's good to see. The valuation, when I conducted the discounted cash flow model, and I updated this today, I updated it by increasing the intrinsic value by a couple of dollars. So I adjusted the free cash flow expectations over these next few years, and that resulted in the intrinsic value per share rising to $54. Previously, I think I had it around $52, the intrinsic value for Shopify stock. Still, it compares unfavorably. The current market price is $104. And then when I look at the valuation on the price to free cash flow, it's 84.5, which is rich. And then the forward price to earnings is 55, which is also rich. That being said, I do believe Shopify stock deserves a premium valuation because the company's now returned to the asset-light business model. It's expanding, it's accelerating revenue growth, expanding operating margins, expanding cash flow, expanding returns on invested capital. It has a very long runway for growth. So all of which points to a company that deserves a premium valuation. However, the premium is just too much. It needs a bit of a pullback before I can recommend Shopify stock as a buy. So what price would I recommend Shopify stock? Hard to say right now, but what I can say right now is that it seems like it's not a buy right now. I think I would reconsider this, reevaluate this business at when the price has an 8 in front of it. A price in the 80s, I think could be compelling. I'll have to reevaluate the business if it ever goes to that level. But right now in the 100s, it's certainly too rich for me according to its current prospects. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.